You've already gotten your first look at this from the previous lessons where we've talked about confirmations of manipulations and a divergence where we implement opposing closed candles, but here we're going to dive into it a little bit more. Opposing closed candles are what we're going to be using in the continuation after a reversal has already been established and confirmed. As long as the market is in a continuation, we expect that opposing closed candles, once closed through, remain respected. So if a bullish continuation, once closed above, we expect that to support price. In a bearish continuation, lower, closing below up closed candles, we expect that to resist price. As long as there is a draw that still remains open, this is the concept that we're looking to follow. And this is a signature that is exclusive to expansion markets. When we set the narrative and do all that work properly, this is a signature that we get, and you're rewarded with something that's so simple but very powerful and consistent. And we're going to use it for a lot of framing trades and also for our entries. As I just briefly went through, and something that you already understand from previous lessons, the same concept applies when we're looking at that confirmation piece for opposing closed candles in the continuation. We have a series here. So this is a bullish example, down closed candles in a series. The close above the highest down closed candle, that opening price, that close above here is the confirmation piece that this low should not be traded back to. If it's a single opposing closed candle, a down closed candle in this example, that close above the opening price is the confirmation. It's the same thing, bearish, flip it. For up closed candles, the opening price of the lowest up closed candle in that series. Closing below that is the confirmation. Here you may be asking yourself, what is generally considered a valid opposing closed candle in the continuation that I should be focused on? And there's one general rule to be following, and that's when you're looking at either a series or a single opposing closed candles, we're looking for a wider range and a larger candle body. So 1 and 3, these two examples, we have a series of down closed candles, large candle bodies, smaller wicks, offering a wider range. 3 has a large candle body and a wider range. But when we compare that to 2, which is considered invalid, even though we have that close above the opening price of this down closed candle, this is not something that we would consider a protected low in the continuation because we have a large wick to either side, a very small candle body, and also a generally small ranged candle. That is not going to protect your stop loss in the continuation. We really want to see these bulky candle bodies and this larger range on the opposing candles because we know that in expansions, the market is not going to make deep retracements back down or against the trend that it's currently in. It has urgency to go in one direction, and we have a larger range like that close through. It's unlikely the market is going to drop all the way back down and then continue again. That's really what you're looking for. When you have these smaller ranged, it doesn't work in the same way. Again, repeating the logic that we've already gone through when we're setting that invalidation point after getting the closes through, it is different depending on the step of the model that you are in. If you're using it for higher time frame framework, you're using equilibrium from the highest candle body to the lowest candle body, marking that out. We want to see price remain above it if bullish, below it if bearish. If we're looking at an entry on a lower time frame, once we get that close through here and here, the invalidation point is on the opposing swing point. That's where we're putting our stop loss. That is the true invalidation point when considering an entry.